Everyone has their eyes on rates, specifically the movement of them. Whether you're wondering when you should lock in the rate on your 30-year mortgage or the fluctuations to the rate on a high-yield savings account, we're all impacted. So what's next for rates? And here's the question: is cash really the best place to be right now? We're going to discuss that and more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being here with me, and welcome my guest, Nick Sarkasy. He is from Shankman Capital, CFA Principal and Portfolio Manager. Nice to have you, Nick. Good to see you.
Great to be here.
You know, so I'm going to sort of bury the lead here and go right in with the big question, which I think is where we want to end up talking about anyway. Is it time to move out of cash? Because we're sitting here, the 10-year right now, the 10-year Treasury is sitting around at 440. The Fed might cut once, maybe twice, but it seems like we're looking maybe more for a slight cut this year before the year is over. Is this the time to be in cash, or should we be looking for other instruments?
Obviously, it's a great question. It's a question we get every day in the fixed income world. So investors need to think about the risk of not taking risk, right? And they also need to be looking forward, right? The market's looking forward. Investors need to look forward as well. So now that they're looking at money market yields or cash-like yields in the low 5% area, they need to ask themselves, what can I earn over the next 12 months? This is the rate I have today, but where are rates looking at? And those expectations, as you mentioned, have changed dramatically, right? In the beginning of the year, the market was expecting 6 cuts from the Fed. So had that played out, or so you would be looking at a starting rate of 530 and an ending rate somewhere in the high 3s. So that changes the dynamic pretty quickly. Today, even though it's become a higher for longer mantra, if you look at the 1-year forwards, right, on the front end of the curve, they're expecting close to 100 basis point cut in the front end. So again, as you're looking at those front end rates, that's not to say that's what's going to happen, but there's downward pressure on those rates. It's a question of when. So investors should really be thinking about that, as well as their opportunity costs. What am I missing out by being here at 530 that feels all nice and cozy?
Right, especially as you said, we expect rates to decline at some point. So why not lock in something now where you're getting a higher yield on a fixed income instrument? I started out in this business, as we talked about, many years ago, and I was very green. And when I came in the late 90s, interest rates were high on savings accounts and money market accounts. And I was like, wow, it's going to always be like this? And of course, we learn as we experience the markets that it's not always like that. So I remember when they went down to 1%, and there was even talk of breaking the buck back in the early 2000s. But here we are today. So given the fact that there are a number of fixed income instruments out there, and we talk about them a lot with our different guests on the show, what should investors be considering here, given, as you expect, rates are going to decline at some point between now and next year?
Yeah. So this is unlike your traditional yield curve, right? If you look over time, the traditional spread between the front end of the yield curve and the back end of the yield curve is about 130, 150 basis points.
And it's still inverted.
Yeah. So today we're the opposite, right? We're inverted. Your shorter rates are at about 90 to 100 basis points higher than your 10-year rates. So I think that's unusual for investors, and they really need to think about not only the yield that they're getting on whatever part of the fixed income curve they're investing in, but also about the duration, right? So I think historically, if the view was, hey, rates are ultimately coming down, why shouldn't I take on duration by going longer in the curve, say closer to the 10-year mark, so that my fixed income exposure or portfolio can benefit when rates ultimately do come down. But the problem is, because the rate curve is so inverted, right? If you look at forward curves for the 10-year, they don't have the 10-year moving much over the next 1-2 years. Why? Because they have to undo their inversion, right? We have to get back to a normal type of yield curve inversion, and it'll still take some time. So as investors think about yield, they should think about not only what yield am I getting, but the total return potential over that forward horizon, thinking about duration.
Right. And with duration, as you wrote, I read some of your notes, and you were talking about how you have longer dated bonds, they have higher maturities, they have more sensitivity to the markets, which their duration is higher. So is that something you would be avoiding? Is that Would you consider that a challenge, in other words?
So it doesn't seem you're really being paid to take on that duration risk, right? You've seen it year to date. Longer duration parts of the fixed income market have actually seen negative year to date returns. And then last year, you were seeing a lot of pressure in the beginning of the year until the Fed pivoted towards the end of the year. And certainly 2022 was a pretty brutal year for duration. So I think if you look at forward curves, and they seem to kind of make sense in that, hey, if we're going to get back to a typical inversion, you may not see much movement on the 10-year, so you're probably not being well compensated from being long duration.
Right. I mean, looking at the yield curve today, you've got the 3-month, 6-month at around 5.5, 5.25, and like we said, the 30-year. The longer you go out on the curve, your yield is not that as attractive as it is right now. And the 10-year, like I said, it's sitting at a 4.40. Are there any particular parts of the fixed income asset class, particularly that you are interested in or you would recommend to investors right now?
Yeah, sure. So if you look at your money market type rates, obviously they're floating rate, right? So they're not going to get a benefit from a decline in rates. You're just going to be earning a lower rate of return as those come down. So the lower duration parts of the curve are attractive because if you have some duration, you'll benefit from where the rate cuts are going to be, which are going to be more towards the short end. In terms of higher yielding opportunities, I mean, our firm's focus is on below investment grade corporate credit, but if you look at the higher quality, shorter duration parts of the high yield universe, so say the ICE B of A, H42C index, that's yielding about 670 now. So you can get higher yields with lower duration where you're being compensated for that, for not being that far out in duration, but you're certainly getting more than you are in cash-like alternatives.
Yeah, I've been reading from different shops like yours and others where a lot of investors, investment managers and portfolio managers are saying this is a golden era for fixed income or words of that nature. But there are always risks involved, right? Still volatility is an issue. We're clearly looking at a very volatile market, and maybe we expect that to be for a little while. It's been 2 years of pretty significant and ups and downs in vol. Between that, what are some of the risks that you really look out for, Nick?
Yeah, so I think a fixed income investor's objectives are pretty much always the same in many different types of market environments, right? The question is, how can I increase the yield on my fixed income allocation, but how can I do that without dramatically increasing my risks? So, and the risks that they're always managing are going to be credit risk, duration risk, volatility risk, and liquidity risk, right? Hey, I can get my yield up, but do I have to go overboard on one of these risks in order to get that? So I think investors need to be cognizant of all those 4 risks. I think duration risk crushed investors back in 2022, and then again in the early parts of this year. So I think they still need to be mindful of that, but there definitely are ways that they can enhance their yields while managing those 4 risks that I mentioned.
And last thing I'll say is, the higher quality, you talk about this in a note, the higher quality short duration part of the high yield market, you said, has been a bright spot through a lot of that volatility since 2022. Is that still the case today?
Yeah. So year to date, it's still positive, returning one of the brighter spots within fixed income, as I mentioned, where you're seeing the longer duration parts of the market still have negative returns with the interest rate volatility.
Excellent. Nick, thank you so much. Great conversation. Honestly, this is, and we talk about this a lot where we're, advising investors to make sure they're talking with their financial advisors because there are really good places, instruments to put your cash to work. And clearly this is just another, part of that story that we're happy to share with our viewers. So good to have you here to talk about it with us.
Great to be here.
Great. Nick Sarkozy from Schenkman Capital. And thank you all for joining us. For more information, please visit our website at ubs.com/views. That's our insights page. Plus, you can follow UBS on all the social media platforms, including Instagram. Our channel there is at UBS Trending. So give us a follow and get some great content on the go. And as always, if you have any questions about your portfolio or anything that Nick and I spoke about today, make sure you're making time to talk to your financial advisor. Until next time, I'm Anthony Pastore. We hope you all have a great day. And remember to keep your eyes on what's trending. We'll see you soon.